Right now in our virtual green room, Todd Horwitz. He's the president of Bubba Trading and the author of Bubba's Guide to Trading Options. Think about that, 25-plus year market veteran and host of the Bubba Show. How you doing, Todd?
Great to be with you, Kate. I'm doing great, thanks.
So
markets are volatile. What could be better?
I was just going to say that. And it's funny because that's the first thing Ed said when we started to rock and roll earlier in the week. And, I've been seeing now that there's even these basic definitions of volatility out there. And I think everybody who listens to this show understands what that means. But why is the average person so fearful of volatility versus somebody who's more schooled and steeped in the markets?
Well, I mean, if you're an average investor, you like it when the markets are overly complacent. You like it when the markets don't move very much because your portfolio doesn't go down very much when it goes down. When you switch into high volatility, which we are now, we went from nowhere to everywhere all in a couple of weeks. But the swings in your portfolio become much bigger. The fear on the street becomes much bigger. You see the newscasters start to sweat when they're talking about the markets. Oh my God, what's going to happen? And traders, they love it because the volatility is the great forgiver when you're getting involved in the markets because the markets go up and down. I mean, if you and I have been talking, the Dow has just gone from up to down in 100 points in a matter of minutes. And, of course, it's extreme volatility. You have to understand what you're doing. But it's the best thing for a trader because it gives you action. And really, it's the best for everybody because it creates more interest in the market.
It definitely does. I think that having been a trader, back in before electricity, we traded with rocks and stuff like that. So I think that the one thing that I loved about it was the ability to go long and short in the market, and also to be on both sides of the market. And that's what trading did for me. When you think about the type of trading that you do, what other things do you think that enhance your returns or make your returns look better in a market that's volatile versus not being volatile?
Well, I think if you understand volatility and you understand, I trade everything, so I trade futures, options, stocks, and commodities. But if you're trading options, you have to understand where, can you be a buyer of volatility here or should you be a seller of volatility here? And that's how you kind of enhance in the ability to trade long and short time frames as well. And I think that's something that many people make the mistake that they buy something to invest in, but it does so well so quickly they sell it. And when they buy something that didn't do well, that they meant to trade, they turn it into an investment. And that's always
true.
a problem that nobody can enhance their own returns.
That's true. The trade that becomes an investment, those are always funny. I always like that. The one thing I like about the market as far as volatility is concerned when it comes to derivatives is the numismatic value or the non-contract value, for lack of a better term, that works out as far as the market is concerned. Because as a seller of options, for me, it gives me a better chance to take in more premium. Do you see the same when you're on the short side?
Yeah, you do now. And you also can create, I'm not a big, especially for the average person, I don't ever talk about selling naked options, but you can create wider spreads with more premium. And, of course, what do we know one thing? That volatility, even when it's going higher, it's going to come back and sell back down. And when it gets too high, for example, the spiders right now, they were averaging trading at an average volatility of about 9. Now they're trading at 30, which is a little bit rich for them. They can't support that, and that's when people make a mistake in the option market. They start buying volatility when it's too high, and when it's too high, you're already pricing in a movement that can't happen. So it's very interesting when you start to look at the way that the markets move, and you get more premium for being able to take shorter sides, and you can go farther away because you get more premium.
Is that the biggest misconception people have when it comes to options? Because I think that's where a lot of the mistakes are made.
The biggest problem for the average retail option investor is they don't understand volatility. They don't understand what's called implied volatility, which is pricing the option forward. And when they do that, what happens is they'll overpay. I'll give you an example of a couple of years ago when Google was going to have boxcar earnings. Everybody knew it. The whole street knew it was going to be great, and retail just kept coming and buying and buying and buying. And sure enough, Google had boxcar earnings. The stock went up to $60 or $70, and everybody who bought the out-of-the-money options lost money because they overpaid for them. And that's a big thing. I mean, I can go back to 2008 when a certain party bought a lot of puts in the market when the market was at 11,000 still in November and held them all the way till March when the market went to 6,000. The problem is that volatility collapsed and the puts were worth nothing. Even though he was right, the volatility collapsed. And that's where people make their mistake. They don't understand how the implications of how implying future movement and how to price in the move. And if you can price in the move, then you have a much better chance to be successful trading options.
That's something that scares people a lot, though, as far as option trading is concerned. For me, it made my whole day. And I'll actually tell you a short story, the best option trade I ever did in my life, which kind of falls on the short side, but hopefully you'll forgive me for that. But I sold short the Yahoo April 500 calls in March of 2000, which was $15 a contract. Obviously, everybody was really euphoric about the internet stocks, and they were all going to the sky. I remember CNBC and the Qualcomm call, where the Qualcomm was going to $1,000 a share, and we were all idiots if we didn't believe it. And I was really a fan of not necessarily believing the hype. So I think that what options do more than anything else is they give people a chance to play both sides of the market and give them a chance to both hedge their positions too, if they understand the nature of volatility and how it plays a role and how you maximize portfolio returns. Would you agree or disagree with that?
I would agree 100%. In fact, I'll go one step farther. I mean, you will make usually your biggest trades will be winners on the short side. But I actually teach people how to hedge their portfolio using options, so that instead of puking it out at the bottom of the market like many of them are doing today, they're actually buying more stock because they're being able to. So that's a very technical term, It's the tap on the shoulder and the big puke. That's what we talk about in our forum.
Yeah, the tap on the shoulder. I think I prefer the tap on the shoulder versus the big puke. But it's pretty interesting. I mean, I'll give you an example. I got in with Alibaba because I like Jack Ma and I liked I started to pay attention to what Alibaba was doing, and I got in. I don't know. I think it was 70 something, and you see that stock and what happens with that. And I've seen some other people that did the same thing, and they panicked because they saw a spike. It went up. What was it, like 81%, something like that in 2017? And then people started to throw puts all over the place, and kind of messed up with some of the bigger gains they had. And so, as you say, you got to kind of watch that volatility, but ride it. And is it an investment or is it the short-term gains?
I think the biggest thing is understanding it. And would you say so? I mean, understanding what volatility means to a portfolio in lieu of fearing it.
Oh, 100%. Again, if you can learn, if I could make somebody learn one thing, it would be to understand what implied volatility is and what it means and why it's if you understand it, you won't make it doesn't mean you won't lose money, but it means you will not make the mistake that makes you a loser when you put the trade on. And that's one thing we want to always make sure is we don't want to be a loser when we want to put the trade on. At least we want an opportunity, right, to make some money.
And as you said earlier,
it's very important that they understand.
And as you said earlier, the trade that becomes an investment, that's part of it there too, because all of a sudden you get to the point where you want to win back what you lost, and you end up losing more and more and more because you're unwilling to accept the fact you were wrong.
100%. People do that all the time, and that's how they get broke.
So exactly. So how do you truly hedge your portfolio?
Well, there's a little mathematical formula that I created that you actually use a back spread out in the future against one side of your portfolio to protect it down, and you sell premium against the upside. But in the meantime, you have unlimited risk, unlimited reward to the upside, and you have limited risk to the downside. But the beauty is when it's going down, you're actually creating more cash to buy more stocks. So you're compounding your portfolio when the markets go down. And so instead of dumping and getting out when the markets are going down, you're actually buying more stock every time it goes down because you're going to roll your option position down and then create more the ability to buy more stock. In fact, a lot of my people bought a ton of stock this week because obviously the markets are getting creamed. So every time they go down 3%, we roll down our hedge and we just take the money we made and buy more stock with it. So you end up with a bigger stock the next time the market goes up, because what do we know for a fact? That in the history of the market, it goes up an average of 8% year over year.
Yeah. And how about, some people like to play it safe and jump all over stocks that have dividends, and I guess we're going to run out of time here, but it depends on the stock,
Can I address that real quick?
Yeah.
I want to answer that real quick just before we got to go. Dividends are great, and I recommend you own them, but dividends are not riskless. And the higher the dividend, the more risk you have from the company. That's why they're willing to pay you more, number one. And number two, if you buy a 10-year note at 3%, you're guaranteed to get the 3%. If you buy a stock with a 3% dividend, you're not guaranteed against the fall of the stock. So you can get all the dividends you want. If the stock goes from 20 to 10, you're getting 6% on 10 instead of 3% on 20.
Yeah, it's tough. Todd Horwitz, we got to run. Thank you. Bubba Trading, check them out. More with CEO Money. Private Equity Spotlight next.